Hey everyone, welcome back to the deep dive. We're diving into a topic today that I know a lot of you are interested in. I mean, let's face it, stock market crashes, they can be pretty scary.
Oh, absolutely. They're one of those things that can really shake things up in the financial world and, send chills down the spines of even the most seasoned investors.
Yeah, exactly. But, as much as we might want to just avoid thinking about them, understanding stock market crashes is actually really important. I
Hmm.
mean, if we can wrap our heads around what causes them, how to navigate the whole, like the turbulence and what it means for our portfolios, well, it can make a big difference.
Right. It's absolutely crucial. It's like having a roadmap for when the terrain gets a bit rough.
Exactly. And for this deep dive, we've got some great analysis to work with, some really insightful stuff. So I'm really excited to dig into it.
Looking forward to it as well. Should be an interesting conversation.
For sure. So let's start with the basics. When we talk about a stock market crash, what are we actually talking about? What is that like? What does that term really mean?
So at its core, a stock market crash is a sudden and dramatic decline in stock prices across a significant portion of the market. It's not just, a few red days here and there. It's a
Mm,
it's a widespread and really sharp drop that can it can really shake investor confidence.
got it. So like a real like a free fall in prices, not just like a little dip.
Exactly. It's more like well, you could almost think of it as a financial earthquake.
Oh, I like that, a financial earthquake.
Yeah.
And when we look back through history, there have been some pretty major examples of these earthquakes.
Oh, definitely. I mean, some of them are almost infamous, right? You've got the crash of 1929, which of course led to the Great Depression.
Yeah.
That's one that tends to loom large in everyone's minds.
Right. Yeah. I mean, that's the one you learn about in history class, right?
Absolutely. Then you have Black Monday in 1987. That was a single day crash, one of the sharpest drops in history.
Yeah, I've heard about that one. That was I think that was even faster than the 1929 crash, wasn't it?
It was very swift. And then of course you have the 2008 financial crisis.
Hmm.
That one played out a bit more gradually, but it was a real crisis with lasting effects.
Yeah, definitely. And I guess more recently we even saw the market take a pretty big hit when COVID first hit back in 2020, right?
Oh yeah, that was a real shock to the system. The market basically froze up for a bit there.
Wow. So it seems like there's quite a range of crashes in terms of like how quickly they happen, how long they last.
There is. Each crash has its own unique characteristics and causes.
Hmm.
But one thing that's really interesting is that despite all their differences, they all share one common element, and that's fear. Yeah. You see, when a market crash starts, it's almost like a sense of panic takes hold. And that fear, that panic, it actually fuels further selling. People start, dumping their stocks because they're worried about losing everything. And that just drives prices down even more.
So it's like a self-fulfilling prophecy almost. The fear itself makes the crash worse.
Exactly. It creates a vicious cycle. So we've talked about what a crash looks like and some of the big historical examples. But what I'm really curious about is what actually causes one of these things to happen in the first place.
Yeah, good question. What are the triggers?
Well, it's rarely just one thing, right? Usually it's a combination of factors that kind of build up over time, kind of like pressure building up and then finally something gives.
Right, like a bunch of little things that eventually add up to one big problem.
Exactly. So one common trigger is an economic downturn. When the economy slows down significantly or even goes into a recession.
That makes sense. If the economy's not doing well, then companies aren't doing as well, and their stock prices are going to reflect that.
Exactly. You see, during a recession, companies tend to see their earnings decline, right? Because people are spending less, businesses are investing less. And that lower profitability makes their stock less attractive to investors.
Makes sense. So are there other things besides like a recession that can kind of like kick things off?
Yeah, for sure. Another common trigger is what we call a speculative bubble.
A bubble.
Yeah. So imagine this, a particular asset, like a certain type of stock, starts getting really popular. Everyone's talking about it. Everyone's buying it. The price keeps going up and up and up. But the thing is, the price is actually getting way ahead of its real value.
So it's like people are getting caught up in the hype and they're not really paying attention to whether the underlying asset is actually worth that much.
Exactly. And that's what creates a bubble. It's this
Oh.
disconnect between the price of something and its actual intrinsic value.
Okay. And what happens when the bubble like bursts?
Well, that's when you get a crash. Eventually, reality sets in. People realize that the asset is overpriced and they start selling. And then everyone else panics and starts selling too, and the price comes crashing down.
Wow. So it's like a party that gets out of control and then everyone suddenly realizes they need to go home and there's a mad rush for the exits.
That's a great analogy.
Uh,
And, one classic example of a bubble that burst is the dot-com bubble of the late 1990s.
yeah.
Back then, there was this huge excitement around internet companies. Everyone was investing in anything with the dot-com in its name. But a lot of these companies didn't even have any real profits yet.
Right. It was all about potential, not actual results.
Exactly. And eventually that bubble burst, and a lot of people lost a lot of money. So we've got economic downturns, we've got speculative bubbles. Are there any other, big factors that can trigger a crash?
Yeah, there are. Another major factor is geopolitical events. Things like wars, political instability, major global conflicts.
Yeah, those can definitely rattle the markets. You see, when there's a lot of uncertainty in the world, investors tend to get nervous. They worry about, the impact on the global economy, on trade, on all sorts of things. And they often react by pulling their money out of the stock market, which of course can lead to a decline in prices.
Right. So it's like a flight to safety. People are looking for safer places to put their money when things are, uncertain in the world.
Exactly. And then you have another factor, which is rising interest rates.
Interest rates, okay. How do those play into it?
So when central banks raise interest rates, it makes borrowing money more expensive for businesses and consumers, right?
Right.
And that can lead to a slowdown in economic activity.
Mm.
Businesses might postpone investments, consumers might cut back on spending, and that can hurt corporate profits, which, as we discussed earlier, can lead to a decline in stock prices.
Okay, I see. So higher interest rates can kind of put the brakes on the economy.
Exactly. And then, of course, you have that element of panic selling that we talked about earlier. Even if the initial trigger for a downturn isn't that huge, once fear starts to spread, it can really take on a life of its own.
Right. It's like that herd mentality. Everyone sees everyone else selling, so they start selling too.
Precisely. And that just amplifies the downward pressure on prices.
Mm.
So, yeah, I mean, it's quite a complex interplay of factors that can lead to a stock market crash. But the key takeaway is that it's rarely just one thing. It's usually a combination of forces that kind of come together.
Got it. And, even though crashes can be, well, pretty terrifying, you said earlier that they're considered a natural part of the market cycle. Why is that? Why is it important to, view them that way?
Well, because it helps us to keep things in perspective. You see, markets don't just go up in a straight line forever. They go through cycles. There are periods of growth and expansion, and there are periods of contraction and correction. And crashes, while certainly dramatic, are just part of that natural ebb and flow.
So it's like breathing in and breathing out. You can't just keep inhaling forever.
Exactly. And, understanding that crashes are a normal part of the cycle can help us to avoid making, rash decisions based on fear. Because when we see our portfolios dropping in value, it's natural to want to, sell everything and run for the hills.
Oh, yeah. I can definitely relate to that.
But if we remember that the market has always recovered from past crashes, it can help us to stay calm and ride out the storm.
That makes sense. So let's shift gears a bit and talk about some practical stuff. Knowing that crashes are a possibility, what can people do to protect themselves, to protect their investments?
Right. So one of the most important things is diversification. You've probably heard this a million times, but it's really true. Don't put all your eggs in one basket. Spread your investments across different asset classes, stocks, bonds, real estate, maybe even commodities, things like gold or silver.
So don't just bet everything on one company or one sector of the economy.
Exactly. You want to spread your risk. That way, if one area of the market takes a hit, the other parts of your portfolio can hopefully cushion the blow.
Makes sense. What about the kinds of companies you invest in? Does that matter?
It definitely does. You want to focus on quality. Invest in companies with strong fundamentals. Companies that have a history of profitability, that have manageable debt, that have a competitive advantage in their industry. Companies that are well managed and that are, likely to weather economic storms.
Okay, so the solid, reliable players in the market, the ones that aren't going to just disappear overnight.
Exactly. Think of them as, the blue chip stocks.
Yeah.
The ones that have been around for a while and have a proven track record.
Got it. So diversify your investments, focus on quality companies. What else?
Another important thing is to keep some cash on hand. Having a cash reserve can be really helpful during a market downturn.
So you're not forced to sell your investments at a loss if you need cash.
Exactly. And it also gives you the opportunity to buy stocks at a discount when prices are down. It's like having dry powder ready to deploy when the market presents a buying opportunity.
Ah, okay. So you're kind of like waiting for the sale to start.
Exactly. And speaking of sales, one of the most important things during a market crash is to avoid making emotional decisions. It's really easy to get caught up in the fear and panic and start selling everything off. But that's usually the worst thing you can do.
Is you're locking in your losses.
Right, exactly. When you sell during a crash, you're basically selling low. And the best way to make money in the stock market is to buy low and sell high. So if you can resist the urge to panic sell, you're much more likely to come out ahead in the long run.
Right. So it's all about like keeping a cool head and sticking to your long-term plan.
Exactly. Don't let your emotions get the best of you.
Okay, so we've got diversification, focus on quality, keep some cash on hand, avoid emotional decisions. Anything else?
Yeah, there's one more thing that can be helpful, and that's to consider investing in what are called defensive stocks.
Defensive stocks.
Yeah. So these are stocks that tend to hold up relatively well during economic downturns. They're typically companies that provide essential goods and services. Things like utilities, healthcare, consumer staples, things that people need regardless of how the economy is doing.
So like the stuff you can't really live without, even if you're tightening your belt?
Exactly. And these companies tend to have more stable earnings, which makes them more attractive to investors during times of uncertainty. So adding some defensive stocks to your portfolio can help to provide a bit of a buffer during a market downturn.
Got it. So it's all about like building a portfolio that can weather different economic conditions?
Exactly. It's about being prepared, not about trying to predict exactly when a crash is going to happen.
Okay. So let's take a look at the historical record for a moment. We've talked about how crashes are a natural part of the market cycle, but what can we learn from past crashes about how markets tend to recover?
Yeah, that's a great question. So the good news is that historically, the market has always recovered from crashes. It might take some time, but it eventually bounces back.
That's reassuring to hear.
It is.
Yeah.
So for example, after the crash of 1929, it took about 25 years for the market to fully recover. But that was a really exceptional case.
25 years. Wow, that's a long time.
It was. But if you look at more recent crashes, the recovery times have been much shorter. So after the 2008 financial crisis, it took about 5 years for the market to recover. And after the COVID crash in 2020, it took just a few months.
Oh, wow. That's a big difference.
It is. And, there are a lot of factors that can influence how quickly the market recovers. Things like government policies, interest rates, investor sentiment. But the key takeaway is that the market has always bounced back eventually.
Okay. So even though crashes can be scary, history tells us that it's not the end of the world.
Exactly. And, one of the most important lessons from looking at past crashes is the importance of patience. It's easy to get impatient when you see your portfolio value dropping. But if you can stay the course and ride out the storm, you're much more likely to come out ahead in the long run.
Right. Because if you panic and sell everything, you might miss out on the recovery.
Exactly. Trying to time the market, trying to buy the absolute bottom and sell the absolute top, it's incredibly difficult. Even professional investors struggle with that.
So it's better to just like stick to your plan and write it out.
Exactly. Time in the market is more important than timing the market.
Got it. So let's say someone is listening to this and they're like, okay, all this stuff about crashes is interesting, but the market is actually crashing right now. What should I do?
Okay, so first of all, don't panic. I know that's easier said than done, but it's really important. Remember that market downturns are normal, and they're usually temporary.
Right. Easier said than done, but definitely good advice.
It is. And then, once you've taken a few deep breaths and calmed down a bit, take a look at your portfolio, review your investments, and make sure they still align with your long-term goals and your risk tolerance.
Okay, so like make sure you're not holding anything that you wouldn't be comfortable holding for the long haul.
Exactly. And then, if you have some cash on hand, you might even consider looking for some buying opportunities. Remember, Warren Buffett's advice, be greedy when others are fearful.
So like use the downturn as a chance to like stock up on some good companies at a discount?
Exactly. But, of course, do your research and make sure you're investing in companies that you believe in for the long term. Don't just buy something because it's cheap.
Right. Quality over quantity.
Absolutely. And then, another thing you can do is stay informed. Keep up with the news. but be careful about where you get your information from.
Yeah, there's a lot of noise and misinformation out there, especially during times of volatility.
There is. So stick to reputable sources and don't let the headlines dictate your investment decisions.
Got it. So stay calm, review your portfolio, look for opportunities, stay informed. What if someone is just feeling really overwhelmed by it all?
If you're feeling lost or unsure about what to do, it's always a good idea to talk to a financial advisor.
Mm.
They can help you assess your situation, make a plan, and just provide some reassurance and guidance.
Right. So having an expert in your corner can be really helpful, especially during tough times.
It definitely can.
Okay, so as we wrap up this deep dive, what's the key takeaway you'd want our listeners to remember about stock market crashes?
Well, I think the most important thing is to remember that while crashes are a risk, they're not something to be feared. They're a part of the market cycle. And with the right preparation and the right mindset, you can navigate them successfully.
Right. So it's not about trying to avoid crashes altogether. It's about knowing how to handle them when they happen. Yeah.
Exactly. And one of the best ways to handle them is to have a long-term perspective. Remember that the market has always recovered from past crashes, and it will likely recover from future crashes as well.
So stay calm, stay patient, and stick to your plan.
Exactly.
This has been a great discussion. I feel like I've learned a lot. Thanks so much for sharing your insights.
My pleasure. It's been great talking to you.
And to all of you listening out there, as you think about everything we've talked about today, I'd encourage you to consider your own risk tolerance and how you might react during a market downturn. It can be really helpful to visualize different scenarios and think about how you would respond. That way, if a crash does happen, you'll be more prepared and less likely to make impulsive decisions. And remember, the key to success in the stock market is to stay informed, stay disciplined, and stay focused on the long term. Thanks for joining us for this deep dive.